Hello, hello, hello. Welcome to the Max Options Trading Beginner course. Can you hear me? Can you hear me? Can you hear me? Hello, hello. If you guys can hear me, give me a quick push in the chat. Who do we got here today? Who do we got in the chat? John. Good to see you, John. Thank you, thank you. All right, let's dive on in. Helios, my friend. You're definitely going to need a couple things for today. Pen and paper and this empty notebook. It shouldn't be empty because you should have so many notes from the class that we've been taking. We're on day 8 already, ladies and gentlemen. It flies by. Whether you're taking notes on your phone, laptop, PC, or tablet, that empty notebook, that empty Excel spreadsheet, whatever you high speeds are you doing, make sure you got it for today because we're going to go over and create your first trading plans. All right. Course schedule. So week 1 was a huge fun success. We chose the right contracts. We know about Greeks. We know SNR. We got candlesticks, intro to brokers. We had a great weekend. We learned massive amounts of technical analysis on Monday. We learned my day trading and swing trading strategies and how to look for them yesterday. And that brings us into discipline and risk management, as you should start growing on becoming a trader and practicing these paper trades and building in your skills. And with this newfound tool set that you have, we're going to go over discipline and risk management now, how to protect it, common mistakes, some trading psychology. And that will lead us into some advanced option strategies. And I'll teach you guys how I pay myself as a full-time trader. And I'll set you back off to the Discord to be successful traders and participate in a full-time community. Thanks, guys, for those who were early and discussed a little bit. Make sure you guys have a nice, quiet place free of distractions. I get very passionate about risk management discipline. I might say some wild shit. I might start yelling at you. I don't know, honestly. Please be respectful at all times during this course. Stay on mute. If you guys have any questions at all during this time at the session, please write it down. Wait till the end of class. Stay focused, stay on task. And some foul language may be used. This is an adult setting. If you have sensitive little ears, please put your headphones in. Before we begin, make sure you guys are following us on our social media, Max Options Trading, Max Options Trade on Twitter. I post a lot of my spreads on Twitter as well. I post a lot of plays, like retweeting, and I have fun on Twitter. I'm a funny guy, all right? Instagram, the big account, Max Options Trading. If you tag us at Max Options Trading while you're taking the class, we'll tag you right back and give you the clout you deserve. Thank you for your support. Follow Max Options Trading with 2 G's on TikTok. I love posting stupid TikToks. I'm funny as fuck. I don't do any like the normal trends, but you can follow us on Reddit at Max Options Trading for some good articles to debate and talk about. And don't forget to follow us on YouTube, like and subscribe, baby, because we got a lot of great educational free classes like this one coming out on our YouTube. Discipline and risk management. All right, before we begin, let me get a sip of bubble water. Hope you guys all had a great day today. I made about 4,000 a day on some hedges, keeping the portfolio nice and green, baby. We're up to about 179,000. So I'm trying to get to that 250 mark by the end of the year. I'm seeing the goal and I'm visualizing it. All right, let's do this. What is discipline? Okay. Discipline means following your trading system rules strictly and precisely. Traders lose because they fail to follow their trading system rules. Maybe you don't even have rules, but don't worry, we're going to go over some today. They lose because they have no discipline. Self-discipline means the ability to control one's feelings and overcome one's weaknesses, the ability to pursue what one thinks is right despite temptation to abandon it. Okay? Some principles here. The market is rewarding to those with discipline, whether it's you waiting for the right time to enter a play, knowing when to cut a play, knowing when to let the winners ride. The market's very rewarding to discipline. Don't ever let a winner become a loser. If your trade is green, there's no damn reason or excuse for letting a trade go red. You should stick to a proven trading method that works for who? For you. Trading is a journey that only you can take. You can find some keys to fix your puzzle pieces on the way, but trading is for you. Never chase a trade or overtrade to make up losses. Never chase or overtrade. All right. Those are two easy ways to lose money. What do they call it? They call it a FOMO, the fear of missing out. Will cost you longer in the long run than it will for gains. Trust me. Never enter a trade without the proper knowledge. Why? I get it if you're in the Discord and you're paying for alerts and from analysts, and that's why you're just like, hey, I'm here for the alerts. Understand, but try and figure out the why. The why is so important when it comes to options trading. Why are we taking this trade? Once you get that understanding, that depth knowledge, then you'll start making much better decisions. Learn how to cut your losses. A lot of people have problems cutting their losses. I'm down 30%. I'm down 40%. Well, let's just wait and see what happens. They have no technical analysis, no nothing. They just have a drug called hope. Have patience. It will reward you. And respect your stop losses as you would your parents. I put that in there because everyone should have some respect for their parents. I think I was even like 15, 16 years old before I started cursing in front of my parents. You should have some respect for your stop losses in the same manner. If you don't, you're just going to bleed your account in the long run. There's a lot more percentage of traders who fail than succeed. And this class is going to explain to you why. All right. I want everyone to write this down. This is something that I say all the time, and I truly believe it. All right. Profit is only profit when you close the trade. All right. So I have a question for everyone here. Why the hell do people say they made profits on a trade that's still open? And if you've done this, go ahead and stop and do 5 push-ups. Okay, because you did not make profits on a trade that's still open. One piece of news can come out and boom, as quick as you can blink, that profit could be gone. So if you're one of those people, stop doing that. All you have is an options contract that's worth more equity than you paid for it. But profit is profit when you secure it. Otherwise, you just have an unrealized gain with more equity. That's it. But you really haven't realized shit. That's so important to remember. Let's talk about the risk to reward ratio. The risk to reward ratio is straightforward. It's a ratio that basically compares the anticipated returns of entering a position with the potential losses that may be incurred by entering that position. My risk to reward ratio, I always look for 1 to 3 minimum or 1 to 4 for entries, and that hope we want to basically get those ones up to 10 to 1, 12 to 1, so every 10 trades you hit one of them, pays for the other 9. But the risk to reward ratio is used by traders and investors to manage their capital. The ratio helps assess the expected return and risk of a given trade, and an appropriate risk to reward is anything greater than that 1 to 3. You can use stop losses to keep your risk to reward ratio intact, whether it's a mental stop loss or a hard stop loss. I'm not telling you have to set a physical stop loss for every trade, but have some fucking discipline that when you say, I'm cutting this bad boy at 10% down and it hits 10% down in your mind, cut the trade, stick to your plan, stick to your risk to reward ratio. All right. If you have a daily goal, quick question, everyone, and be honest, do you respect it? So everybody has that number. For me on my small account, it's $200 a day. We'll keep the day jobs away, baby. You've heard me say that before. Only $200 a day keeps the day jobs away. On my big account, it's $4K a day. $400 a day is over 6 figures annually. Did you guys know that? Even if you take 20 vacation days, you'll come just under 6 figures. It's pretty cool, right? $400 a day. A lot of traders can see that kind of action in seconds. What's your number? Do you guys respect that number? Do you stop trading during the day or the week when you hit your number? Do you ever overtrade on a day with losses to reach that number and dig your grave just a little bit worse? Just dig in your own grave with those overtrading. You guys do that? Think about these questions here. The better you get to know yourself and what disciplines you continuously break, the better you can fix yourself and become a better trader. Let's talk about position sizing. This refers to the size of a position with a particular portfolio or the dollar amount that an investor is going to trade. Investors use position sizing to help determine how many units of the security that they can purchase, which will control risk, and maximize the return. So traders should develop an informed strategic methodology for determining the size of a trade, rather than randomly selecting a position or electing a predetermined size for all trades. Before determining a position size, a trader must first understand the appropriate stop level for that specific trade. For a trader, the stop level can help determine the risk depending on the size of the account. You should risk a maximum of 1 to 3% of your account on a trade. Okay. Now, this is a misconception with a lot of people. So what you're risking is the total size that you enter. So my account, let's just say my account's at $10,000. 1% of $10,000 is $100 to $300. Now that's 1 to 3%. Okay. But if you enter a trade that's $1,000 and your maximum stop loss is $300, then you're still risking, if you set that with the play, then you're still risking only 3% of your account during that trade. But your risk to reward ratio is a little bit different there. But you have to have the discipline to be able to do this instead of this. But if you're in the long game, this one will pay you more. For larger accounts, there's some alternative methods that can be used to determine position sizing, including implementing a fixed dollar stop amount. If any six-figure traders like myself are in the audience, please don't hesitate to ask me what that means, and we can talk about some alternative methods in which you can scale your account using different portfolio sizing. So to achieve the correct position size, traders first need to determine your stop level, how much you're willing to risk, and the percentage of dollar amount their account they're willing to risk on each trade. So once you have this done, then once you determine those, you can calculate your ideal position size. You guys shouldn't be like, you know what, this day trade, I'm feeling good about this one. I'm going 500. And then you know what, this is a lotto, but I like this company a lot, so I'm going to do 1,000 on this one. And the whole time you only got $4,000 in your account. That's not how trading works. You should know the amount that you can risk. When I play my small account challenges, I turn 2,000 into 18,000. I turn 1,000 into 7,000. And I do this using strictly risk to reward ratios of what I'm willing to lose and how much I'm willing to make. For those smaller accounts, you guys should know, okay, I'm going in on this amount, but I can only lose this amount. And if I win 40 or 50% of the time, I'll grow this baby account into something big in the next couple months. All right. What is the only time that you could increase risk in a trade? Do you guys know? There's actually two ways, but I'm only going to talk about the negative one. There's a good one as well. Does anybody have a clue of what I'm talking about? What could be the only time you can increase that risk on a trade? Never. No, there's time. There's a time, Helios, where you could. I've done it a lot. A lot of people do it. Does anybody know? So let's talk about averaging down. So when we mention averaging down or tapping an average, there's two different ways that you could do this. The first way that I like to do this is purchasing the same contract. That will bring your average price dramatically down. So if you had 10 contracts at $1 each and you purchase 10 more contracts when the average price is now 50% lower at 50 cents, you would have 20 contracts, but the average is 75 cents now. Usually on the next bull or bear rush, this would help you get to break even in order to exit the trade. But you do this at key support resistance levels at certain times. This is very dangerous as you're exposing yourself to double the risk, though. So please remember that. If you're averaging down or adding more contracts, you're just adding more risk. A lot of people do this emotionally instead of technically, and they wind up getting burned. Big mistake. The second way of averaging, I kind of sound like, you heard that? I sound like Julia Roberts there. For what's that movie where she's a prostitute, right? With that guy. That's why, geez, I'm too old. The second way of averaging down would be purchasing a new contract at a safer strike price and a safer expiration date. So for example, if you had Tilray $10 calls on 417, if you think Tilray is going to make a rebound, but $10 may be too far out of the money now, you want to lower the risk, you could purchase Tilray's $6 calls on 424. So you're rolling out the expiration date and you're rolling out the strike price, bringing it much closer. Now, this is a significantly less risky trade. And so this would average you out completely. If the stock bounces back up, your $6 calls will be in the money, and you could completely average out or even surpass the negative balance of the $10 calls. And that's a second way of averaging down. I call this one averaging down and out, because you're bringing the strike price down and you're bringing the expiration price out. These are the two methods that I practice when I talk about averaging down. Either one of them work well but you got to try and average down as minimal as possible. You don't want to do it it's only done in hopes to exit a trade that's going south with a stop loss of like 1% to 2% gains. Because when you average down, when you add that risk, the purpose of it is to start deducting that risk as soon as possible. Risk management. All right. Risk management is the process used to mitigate or protect your trading account from the danger of losses. Let me say that again. Risk management is the process used to mitigate or protect your trading account from the danger of losses. Losses will happen in trading. Trading can be exciting. It's even profitable for some of us if you stay focused, do due diligence, and keep your emotions at bay. Much, much harder to do than it is to say. Trust me. Still, the best traders need to incorporate risk management practices to prevent losses from getting out of control. I am a risk management junkie, by the way. I love risk management. When I see the market hitting key upper levels, I put tens and thousands of dollars of risk management hedging into my portfolio just to stay flat at best. And this kind of overall risk management in the long run, this is what makes people good money. Jesus, what the hell did I just say? Having a strategic and objective approach to cutting losses through stop orders, profit taking, and protective puts is a smart way to stay in the game. Remember, I say this a lot to people that are having problems. The stock market's going to be there tomorrow. All of us traders will be there tomorrow, but are you going to be there? Are you going to do something stupid? Are you going to be around to continue this secondary stream of income? That's for you to answer. Write this down. Great traders only have good risk management. Great traders only have good risk management. Who says that? I say that shit because it's true. The best traders around all manage their accounts, their risk, their portfolios appropriately. Trading psychology. Trading psychology. Successful investors must have mastered two emotions. What are they, chat? Someone let me know. What are the two emotions that successful investors have to keep at bay? They know they mastered these emotions. We get a sip of bubble water. I want to hear some answers. Man, that shit is good. Impulse, fear. Fear is one of them. Greed and fear, NSP. Nailed it right on the head. Fear, good answers. Greed and fear, everybody. Let's talk about fear. When traders get bad news about a certain stock or the economy in general, they naturally get scared. They may overreact and feel compelled to liquidate their holdings. This is the dumbest shit I've ever seen. If you're in fundamentally strong stocks and you're in shares, there's never a reason, like if you have Apple stock, there's never a reason to be like, oh, I'm going to sell Apple. You know, it makes no sense. Smart investors over time will add to during the dips. Fearful investors will cash out and miss out on the long run. Refraining from taking any more risk. If they do, they may avoid certain losses, but they also miss out on long-term gains. Trust me, you will miss out on the long term. Traders need to understand what fear is. It's a natural reaction to a perceived threat. In this case, a threat of their potential profits. Perception is reality. So if you think things are going south and it's going to cost you, you tend to start panicking. You tend to start getting fearful. Quantifying the fear might help. Traders should consider just what are you afraid of? Going broke, failing, not being a good trader, bragging about your gains one day and blowing up your account the next, right? This is what you're afraid of. But thinking that it should occur before the bad news, not in the middle of it. So you need to prepare. How do you prepare for this? Discipline, risk management. Practice. Thinking your trades and everything ahead of time, traders know how to perceive events instinctively and react to them. And then you can move past the emotional response. If you've ever lost $2,000, then you should know, I know what it felt like to lose $2,000. I won't let it happen again. Of course, this is not easy. Like everything I've said right now, it's not easy to do, but it's necessary for the health of an investor's portfolio, not to mention you, the investor. If you stress and you're fearful and greedy and your emotions are just all over the place, you're not going to get out of trading full time alive. I'm telling you, you're not going to be able to do it. If you are one of those people, protect your money. Go put it in something like an ETF like SPY or an index fund and just keep adding to it over the next 30 years. You'll still be a millionaire. You're just not going to have as much stress or as the chance to gain compounding equity. Fear stands for two things. It could either be false evidence appearing real, or for everyone that lets their emotions get the best of them, forget everything and run. How do you perceive fear? Let's talk about greed and overcoming it. There's an old saying on Wall Street that pigs get slaughtered. All right. This refers to the habit of greedy investors hanging on to a winning position too long, trying to get that every last tick upwards in price. And sooner or later, the trend will reverse and the greedy get caught. The pig will get slaughtered. All right. You can't be greedy. Part of your discipline and risk management must be when to trim and take profits. Okay. I'm going to show you guys here in a second the best way to do this. And this is the way I do it. And I'm going to say it's probably the best way. We'll see in here in a second. Greed is not easy to overcome, just like fear. It's one of those emotions that just takes control of your body. It's often based on the instinct to do better, just to get a little bit more. But a trader should learn to recognize when they're being greedy and develop a trading plan based on that rational thinking. That's not a whimsical instinct. Okay. You need to have in your trading plans, oh, fuck, I'm getting greedy. What's the contingency for greed? I know I'm being greedy. How do I write this out in my trading plan to exit out? How do I get control? That recognition of your own emotion is what, and practicing overcoming it is what's going to help you be a successful trader and a successful person in life, honestly. Greed kills accounts. Write this down in your trading plan right now in all capital letters. Greed kills accounts. The market will be around tomorrow, but will you? Write this. Greed kills accounts. Can't say that enough. Trading is not emotional. Highlight this and put this on another page of your trading plan. Trading is not emotional. It's technical. Who says this? I fucking say this all the time. Another maxism right here I'm throwing at you guys, all right? It's not an emotional thing. When you can learn how to truly take the emotion out of trading and only do it by technical, your profits will skyrocket. This is my risk reduction method, okay? So really get the pen and paper out now. If you guys didn't have a trading plan on how to start taking profits, taking losses like on the chin, this is how you're going to start doing it, all right? So for day trading, I do 3 to 5% of my account in every trade. That's what I'm willing to risk, 3 to 5%. Okay, I know I just said 1 to 3, but day trading may take some more equity. If you want to be a day trader, you got to put your money where your mouth is. So I'm teaching you guys the practices, but I'll go 3 to 5%. I'll put 5-10 grand on a day trade. You should always take half the gains at 10 to 15%, and then just take the rest at 20 to 30, or let 1 or 2 contracts ride and try and get some compound gains. But trimming those profits quickly and at a good 20, 30%, that's the best quick money you'll get. Another way is take half the gains at 10 to 15%, and then take the rest at 0 to 5 if it starts reversing. But never let a trade go red. There's no excuse for it. Use your stop loss, use your mental stop loss. I don't give a shit, just do it. You should cut losses on a day trade at only 10 to 20%. Usually, if you're down 10 to 20% on a day trade, it's going to take a significant reversal to get that 10 to 20% back up to this profit-taking levels. So just go ahead and cut it, find out what happened, and see. But if everything looks really good, like if you're at down 20%, it's just consolidation, or it hasn't completely broken out yet and your TA is still intact, you can assess the situation for an average down. Remember, you should only do it once, and you should do that as minimal as possible, but it's okay to do. Everyone does it. That's my day trading rules. So that could be the day trading plan for you guys. If you don't have one, let me erase it all for you so you can see. This is my day trading plan up top here. This is what I do every single time, standardized practice. Here's my swing trading rules. I only risk 1 to 3% of my account for swing trading. I take half my gains at my first price target. So I don't use percentages for swing trades. I have designated price targets. And when I'm ready and comfortable, I take half my gains at that first price target. Now, I've had swing trades where that first price target, I was up 200%. And I've had swing trades where that first price target was 10%. But guess what? I still took half that profit. Then I took the rest at my final price target, or when you're comfortable. So if you're still cruising upward and you're saying, you know what, I haven't hit my second price target, but we're losing steam, we're losing volume, I'm comfortable with 40%, take it. Just take it. Nobody goes broke taking profits. No, I promise you, I will make fun of you for everything in the world except for taking profits. Nobody will make fun of you in the world for taking profits. I promise you that. You should cut losses at 40 to 50% on a swing trade, or assess for an average down if only your TA is still intact. So go back in, reassess the situation. Remember, for my swing trades, I always go 4 to 6 weeks out. That's minimum. So there's time. If the TA is still intact, go ahead and assess for an average, getting that risk up, or just cut the trade. If you say, nah, the TA is shot, just cut the trade. There's nothing wrong with that. Never average down on a swing trade more than once in a trading day or on the same day you open the trade. Okay, that's so important. Never average down on a swing trade more than once in a trading day or on the same day you open the trade. I see so many people open a swing trade, then it goes down 15, 20%, and they're ready to fucking throw 10 more contracts at it. That makes no sense, because at swing trading, you know the intention is to swing it. So I'm going to accrue overnight risk, whether it gaps up or gaps down, correct? So if it gaps up, you're going to be up in green anyway. If it gaps down, now that 15 extra contracts or whatever you just threw at it is extremely down. So now you're down 30, 40% the first day, and you doubled your risk already. So wait a day or two. If you gap away from if you're in calls and it gaps down, you can assess for an average the next day or when it hits 40%. If it gaps up, then your trade's good and you're going to make money. So just be patient. Don't ever do that shit the same day. Here's a great way to reduce risk. This is my own personal way. This is just the math. I copied all this shit, the math. I didn't actually do the math, but this is how it works. If you have 10 contracts on a trade, every 12% gain, you can cut 9 of them, and the 10th one is free because your gains have paid for the 10th one. At 25%, you can cut 8 out of 10 and go for a free ride. 7 out of 10 is 43, 6 out of 10, 67. If your contracts go over 100% gain, you can cut 50% of your contracts and let the rest go. This is how we compound those gains. If you're going to go for that 200, 300, 400, 1,000% bag, if you want the screenshot to show everybody on Wall Street Bets, do it this way. Because this way you're minimizing risk and you're doing it on free plays. So even if that last contract drops down to negative 80%, you can still sell it and make profit on the trade. All right. Don't be stupid and don't just YOLO all your shit. Use this risk reduction method right here. Try and get 10 contracts in on trades and try and do it this way. The math doubles. Let's just say you have 100 contracts, same principles. You just do 90, 80, 70, 60, but the percentages don't change. So if you have 100 contracts on something at 50% positive, you could let 50 contracts ride. That could be a huge swing trade in the future. So don't just let them go saying, oh, I'm going to make so much money. Minimize the risk. Minimize all of it by taking your equity out of the deal and then let those gains compound. That's how it should be done, all right? I hope you guys wrote all of this down as I've been talking, because this is a great trading plan I just put in front of you. This is my trading plan. I know it's fucking great. Here's my 4 steps to help control emotion with a trade. Okay, so this is my 4. The first thing I do, my pre-market trading plan. So if I know I'm going to look for a day trade today or swing trade or close some condors, you guys in the Discord will hear me talk about managing trades. That's because I'm on step 4. But the first thing you should do is have a plan. Your pre-market trading plan. Go through your watch lists. We post a watch list for you. If you guys want to do your own, it doesn't matter. Just have a plan prior to the day. If you're saying, oh shit, Tesla got upgraded, I'm going to go in on some Tesla calls today because the last 8 times it's been upgraded, it's ran on 7 of them. So I'm going in on Tesla calls, right? In your mind, before the trade starts, you should visualize and see the trade through entirely. So you're saying you should know, okay, I'm going to take this trade because my, it's a day trade and that's standardized, strike price, expiration date, risk management. I got it all from Max. So now let me think, okay, it's $2,000 trade. I'm only willing to lose 500 and I'm only willing to gain about 5 to 800, 20% to 20 to 30%. That's what I'm going to go for. Okay, if it goes south, I'll cut the trade at 500. If it goes good, I'll start trimming low and hopefully get out of the trade around 15 to 18%. You execute the trade. Trading starts. You say, hell yeah, Tesla looks great on the charts. My TA is intact. I have a good feeling. I'm in. You execute the trade. I already know it could go good. I already know it could go bad. I'm following my plan. And then the last thing to do is just manage the trade and risk completely. You should treat each trade like everything's going to go good or bad. You should have it all set out, but you should have this for each trade. Those people that have like 30 fucking options open, they're idiots. All right. For me, for actual options, I like doing like 2 to 3. 2 to 3 on a good day. You might see me with like 4. But that's it, because I'm on every trade. I'm having a plan. I visualized all those trades. I executed those trades, and then I have to manage them, which is an important thing. This is why in the Discord, you guys probably see me say a lot of days I don't trade. Hey guys, today I have to just manage. I got 10,000 out there. I got to manage it. So that's a full-time job in itself. I don't have to overtrade or continue to trade. But this is what helps me with my emotion, is because I planned it. I visualized it, I executed it, now I'm managing it. I believe they call this the 2/3 rule, which would be spending 66% of your time planning and preparing, and only 1/3 of your time actually doing the work. And that's one of the things that I do for every single trade. And I hope you guys wrote this down. I hope this starts helping you control a little bit of emotion. Discipline is more important than the trade itself. Remember that profits are just a bonus to a good trade. As a full-time trader, I get joy of making a good trade. It makes me feel good because then I get to eat. I'm fat. I like eating a lot. So when I make good trades, I get to stuff my fat fucking face more because I'm a full-time trader. And with discipline, I understand that it's so important that profits are just a bonus to me making a great trade. And you have to have that mindset. You shouldn't think that I'm doing this for money, I'm doing this for money, I'm doing this for profits. You should do this to become a good trader. Why do people average down and not secure profits? I wrote this page out because to me, this makes sense. I'm going to read it to you guys. So you average down on a trade that's down 40%. Let's just say you purchased one more of the same contract and you average it out. Now you're negative 20%, right? The first contract you purchased is at $1. And the second is at 60 cents. So now if you're on your brokerage, it's going to say that you're at 80 cents. So tell me why you don't sell that one contract at 80 cents and secure 33% realized gains on the second contract, minimizing the losses, and then going right back to your first contract for maintaining and managing. Why is that? People get that false sense of, oh, I'm at break even now, so I haven't made any money. No. When you check your PL and your statement, it's going to say you made a purchase at 60 and a sell at 80. That means you lowered your average and you took a gain. You took a realized gain. You have to pay that tax on that one. People for some reason get that false sense of, oh, now I doubled my risk, so it's good. When you average down, you got to secure those profits and take that second trade back off the table. You may be back at break even for both, but in reality, one contract was purchased at $1 and the other was purchased at 60 cents. So you could secure the second contract and go back down to your original risk with a better average and secure the difference in profits. Or you just close the whole trade at break even, taking a $20 loss on your first trade and a $20 gain on the second, washing out everything. The trade changed, and so should your trading plan. All right. So your average down, your pre-market trading plan, when you visualize it, you should see that average down. It's just something that I've always wondered. I think people see the overall return and they get a little blindsided by that, and they forget the actual way that this shit works, that each of those contracts, you open them at different times, 2 different trades. Write this down. I love saying this. This is Marxism 100 in this. Hope is a drug. If you ever at any time catch yourself saying the word hope when you're talking about trading, cut the trade. Just cut it, because you're no longer trading with technical analysis, but with emotional analysis instead. How many of you have said this? I hope this trade keeps going. I hope this trade comes back. I hope it gaps up tomorrow. I hope I can make back 80% of my account's losses, because you just do nothing but hope for shit. Okay? Hope don't fucking work. Get your ass out there, do the work yourself, do the technical analysis, stop being emotional. Go be a drug addict if you like hope that much. There's no room for hope in trading, no room for that anywhere. Let's talk about keeping a trading log. So keeping a trading log, I keep one still. I love it. I have one that's digital, and I have a whole notebook, almost 3 of them now that I've filled up, where I write down the stock name. I wrote down the date and time that I took that trade. I wrote my entry and my exit point, win or lose. I write down the reason I took that trade, the reason for entry. Write all this down, guys. If you don't have a trading log, write this down right now. Create your first trading log. I'll explain to you why in a second. You need to write down the reason you exited the trade, the profit or loss, the percentage or value. What went right or what went wrong in the trade? Did you stick to your trading plan or not? Would you execute this type of trade again? And how did you feel before and after this trade? Write all this down, guys. This is my trading log. This is what I put every single trade. A trading log is the most effective tool for performance management on yourself. Okay. A log can help you track progress as well as study mistakes that you made when entering and exiting a trade. In the long run, these reports will act as a foundation for better executions. If you see 10 out of 10 trades that 5 of them were losses and you didn't feel good in the trade, and it's because you were greedy and you lost it, then you're going to start realizing, damn, I've been greedy on half my trades. They were all green. I let them go red. I didn't have discipline or risk management. When you start seeing this performance log, it starts sticking out like a sore thumb why your trades aren't going your way. And most of the time, it's shit that you can manage. So this is the best way to start getting to know yourself and the same mistakes that you've been making over and over again. And this will help improve your success rates. All you have to do is write this shit down. It takes 5 seconds, like literally 5 seconds. And your trading log is good. Once you have the template written out, you can start doing it without even writing it. But this is what I use. I hope you guys write this down. It's just 10 things, 10 little questions, 10 little fill in the blank answers that will teach you more about yourself than you ever would imagine. So congratulations, guys. You have a trading log and you have a complete standardized trading strategies now. Strategies, book, plan. You have it all now. After that, that's it. So who would you guys rather be? This guy who's down 94%, $82,000 in his account? Or this guy who's up 471%, to $37,000 in his account. You want to be the guy who YOLO'd the left or YOLO'd the right? Who would you rather be, honestly? How do you think you would feel if this was your account? Or how do you think you would feel if this was your account? Think about that. Can you imagine what the guy in the left felt like and the guy in the right? And that's it. Now that you're familiar with a little bit of discipline, a little bit of risk management, the definitions, how I take care, how I handle it, and everything I do as a full-time professional trader, then that's, I think, one of the most important lessons you can learn in trading. I know it was a little bit brash compared to the other ones, definitely more opinionated and informal as it was educational. But thank you guys so much for attending day 8 of the Max Options Trading Beginner course. Thank you guys so much. If you have any questions at all, please at this time ask away if you guys have any questions. If not, leave a review. Let me know how it was. Say, Max, that's some brilliant shit, or Max, you're an idiot. I don't care. Just love to hear some feedback. We're also on Trustpilot, Google, and Facebook. If you guys would leave a review, it means the world to me and the team as we grow our community to give you guys back everything we can. Can you us an example of your trading log, how it's set up, or did you show us already? Set it up whatever's best for you, John. So what I have in the trading log, this right here, mine is like this: ticker, date and time, entry, Y, and then it's exit, Y, what went right, did I stick to the trading plan, did I execute this trade again, how did I feel? That's how mine looks. So it's like a little block like this. So just do it any way that you're comfortable with. It just, make it yours. So customize it. You can do it on an Excel spreadsheet. Is a very easy way. I also have one on an Excel spreadsheet that I'll try and get up for everybody in the Discord. And just write it all out. Once you type it in, it takes all of 5 seconds, and then you'll start being able to track everything about yourself as a trader. When you say hedging your account, what do I mean exactly? Helios, there's going to be another class on hedging. That's not part of the beginner course, but I think hedging and learning how to hedge your portfolios is such a strong, important thing that I'm actually going to make in its own class, becoming soon, brother. But just roughly, hedging is a way to mitigate risk and your portfolio of taking losses when the market starts downtrending and your underlying assets start losing. There's ways to protect your accounts, whether it be selling covered calls, opening puts, doing a whole bunch of different methods to hedge your positions, buying inverse stocks at that time. So we're going to have a class on that. Any big examples of losses you took early on because you let the emotion go? Oh, absolutely, David. David, my friend, in December 2018, I took my biggest loss ever. I lost $31,000 on Amazon. The most disgusting part of this is the 4th day I was in the trade, I was up $6,000. I was up $6,000. I was playing Amazon's Prime Week. And the build up to it, I had made $6,000, which is fine. But I said, no, my trading, I'm making 10 grand off this. I want 10. Well, it never got to 10. It got to 6,800. And then it went down to 2,000 the next day. Then it went down flat the next day. Then I bought more thinking, oh, well, it's going to pop right back up. And it led me down a massive greed theta hole where not even 10 days later, I lost $31,000 on Amazon. I had put $31,600 into the trade, and all I had left to show for it was $600 that I closed out the trade finally before the options expired worthless. And that was literally all because of greed. All because of greed. I had let my TA gone out the window, everything gone out the window. I was just panic buying contracts and cost me $31,000. But guess what, Dave? Since December 2018, I have not had a red month since. I am currently on a 18, 19 month green streak where I've had months where I've only made $300. And then I've had months where I've made $120,000 since then. That's one good lesson. That's why when I teach this class and I teach discipline and risk management, I've made the mistakes already. I've paid for the mistakes that I'm telling you guys. I've made them all, and I've paid dearly for them. You know, I've lost money on greed. I've lost money on fear. I've lost money being emotional. I've lost money being impatient. I've lost money using the word hope. I've done all this, and I've paid thousands of dollars for it, but I've made over a fucking million doing it. So let me do the hard work. That's why when I say this, I have plenty of examples. Trust me. Anyone who says, "Oh, I'm Mr. Perfect," I haven't. They're a liar, or they're just trying to scam. And that's it. That's all I got for you guys. Does anyone have any last questions? Going once? All right. You guys have a fantastic evening. Take care. It was great trade with you today, and we'll see you tomorrow at the buzzer. I hope you guys enjoyed this class, and look forward to reading some of the reviews on it. Thanks, guys. Have a great night.